Excited for you to join. We appreciate it. This is investment walkthrough for the Crest on Colorado Street. As you all have any questions for this, I believe you should have a Q&A feature. You can ask questions if you'd like to. They'll be submitted in the Q&A box, and then we'll try to get to everything at the end. And I'm excited about the opportunity. What is build-to-rent? Man, we're doing a build-to-rent. If you haven't heard of it, you can Google it. You can Google institutional investment, flood of capital to build-to-rent, and you're going to find a ton of articles that come up to it. It's essentially commercial multifamily real estate, except it looks and feels a subdivision with multiple different streets. You drive in a community, you're like, this is a great community to live in. Exactly the same, except we don't sell them, we rent them, and it's horizontal multifamily. So we're excited to do that. And I have a couple of our partners. I'm going to let Derek and Andy introduce themselves through. I've got a slide for the team, and they're going to be here for FAQ. So if you have any questions, put them in the Q&A. We'll just kind of roll through this. So my name is Abel Pacheco. I'm the principal and president of 5 Talents Commercial Real Estate. We're an investment firm here in South Texas. And essentially what we do is we do a lot of syndication, and we invest in great assets in great markets with great teams. So you've seen me put out a good number of deals, I think, recently. My goal has not changed since I've gotten started. It's partner with the best possible people in my network that are in the best possible markets and that have a good grasp on the local market. So that's what I do. We're invested in about $100 million worth of commercial real estate, actively and passively. As a general partner, we're principals probably in like 800 plus doors. We have another couple hundred doors under contract, and that's kind of what we're doing. So this is the walkthrough for this investment. This is a 506C investment for accredited investors. My lawyer gave me I guess the heads up. He goes, make sure to let everyone know this is specifically for a 506C offer, because I'm going to send it out and put it on our social page or whatever that is. But if anybody's non-accredited that's here, just ping me afterwards. I think mostly everybody that I see as on our participant list, your 506B investors. We have pre-existing relationships that allow you to invest on 506B if you're not accredited. But a lot of people here on this call are accredited and a little bit of mixture. So anyways, let's go through this. So I like to start off with the deal just right off the bat. So if 30 to 45 minutes is too long for you, you have the summary right up front. So we are providing an investment opportunity. This build-to-rent development. It's in Lafayette, Louisiana. What are the highlights? It's 98 units. That's a $50,000 minimum investment. There's 2 options. There's a Class A and a Class B, 8% preferred return, or a higher preferred return with a higher minimum investment, 150K. So we'll dive into the mechanics of the offering, but essentially the return multiple is the same. It's 2.15 equity return multiple on both classes. It's just a matter of, do we want a higher pref or not? This invest year projected hold time. So if you have some money and some cash that you want to invest, but you think you want to hold on, you think you're going to need it in 3 years, I would say don't invest it. You always want to look for the 5, maybe even plan 1 year beyond what we're projecting and say, if I can bear with not having this capital in my hands for 5-6 years, perfect. That's the type of investment that you need to be looking into, because this investment is illiquid. We can't pull it out. So, projecting to 5 years, 2 to 5, but, good chance that we're going to exit early because of the deal. As we walk through, we'll explain it. But one of the things I don't see often on these deals is a break-even occupancy of 62%. So rough order of what does that mean? Roughly speaking, there's 98 units. We only need 62% of them, so a little less than 62, to actually be rented. As this investment kind of continues on, it's like, man, to pay the debt. So that's a good spot to be in case something happens that we do not know about. We don't foresee that, but it's a good conservative underwriting point that we kind of built our pro formas to. So again, this is a 506C investment, open to accredited investors only. We put in a deadline here for December the 15th, mainly because of Christmas. We don't want to deal with that stuff that last week. We don't expect that we're going to go that long. So it's it's really, if it's not full, the deal will still be open and the deal will be closed as soon as the deal's full. Actually, right now, I guess this is build to rent's a little hotter than I was expecting. We're at 65% committed today on the raise. So we've got a little bit of spots left. So just kind of rolling through this thing. So let's see. All qualified retirement funds are accepted. And that, in short, that's the investment summary. So if anybody's got to go, you've got all the meaty details. And if you have some time, you can spend it with us. So, okay, let's dig in. So I'm going to cover the executive summary, the asset overview, financials, market. I'm going to talk about the sponsor team and the next steps. On the background, you see some of these beautiful pictures. We're building Class A new development. It is great looking assets that we're building, but let's go through this. So in terms of financials, we mentioned Class A, Class B. Class A is an 8% preferred return. The whole time is the same. You do have, in either side class, you do have equity ownership in either portion. So if we kill it, we crush it, which we're projecting, looking at it, when we do well, our investors do well too. If we sell early, we sell early too. So it's essentially, you have the opportunity to make more than projected, and everybody is a part owner for the investment on there. So the deal, once it's fully baked, all the units are built, it's humming along, it's rented. We're expecting an operating expense ratio at 38%. Some of you all are multifamily commercial apartment investors. Usually it's much higher than that. Ours is pretty low. It's new. We're going to have professional property management, people that, know what they're doing on these things, and break-even occupancy, again, 62%. We are underwriting. If you're an underwriter, you know what this means. If you're not, I'll kind of explain it real quickly. The current market cap rate, people are buying these assets at about a 5.25 market cap in Louisiana, Lafayette, and that's kind of what things are trading for. You could probably get things for a little lower cap right now, depending on how aggressive somebody wants to go, but let's just say it's 5.5. Our exit cap, we're projecting a full 100 basis points off of our entry. So this is basically very generous spread from the point that we buy it to the point that we sell it. That gives us a lot of room. People like me, in my crystal ball, I'm like, God, I hope cap rates compress, which means the assets get more, their valuation goes up. Well, we're projecting, just in case, the opposite. If things go south, well, we've got a baked in room, and you're going to see on these numbers, they're pretty good. In addition, for new development, one of the things that a lot of operators will mess up on, regardless of the asset class, is just not being funded well enough. This property has this investment is carrying $1.23 million of contingency reserve. So we don't expect to hit that, and that'll make the deal even better. But if you look on the right-hand side, so you have sources of funds and uses. So basically, this is where the funds, here's where they're coming from. The uses, that's what we're going to go spend the money on. So the total loan, we're projecting 11.6 million. Investor equity, we're bringing about 2.5 million to the as our equity. That's what we're putting together in the deal, and the total is $14 million. How is the $14 million spent? That's the bottom right-hand corner of this this chart. It's the site acquisition, the development, cost to build, development fee, the loan costs, fees, contingency reserve. That's a total of $14 million is what we have earmarked. On the left-hand side, the bottom left-hand corner, you see target sale price, 16.8. So you roughly have the spread of what we're paying 14 million, and we're projecting to sell it at 16.8. That's how we're making profit on this deal, and everybody splits the profit based on how much we're investing. And the very bottom black with white text. A common question I get a lot have, what are y'all investing? So this team, our general partner team, has about $1 million of skin in the game currently. So to say we're in it is an understatement. 750K in the land, entitlements, permits, architecture, engineering, title, design, all the fun stuff that Derek could probably talk through and answer questions if you guys have any. All the stuff that's already been spent, it's already there. In addition, the team's putting another $350K of additional general partner investment. So that'll be, liquid cash, right? So total that up, $1 million. And I'd say that's pretty good skin in the game there. So anyways, that's the executive summary. I'm going to fly through some of this other stuff, make sure we're staying on time. So 98 units, brand new development. It's on a 12-acre plot of land. There's 98 single-story houses. It's in Lafayette, Louisiana. If you don't know, Google that, the happiest city in America, which is pretty. I'll go through the marketing data points in a few minutes, but Forbes called that. And these are 3-bedroom, 2-bathroom houses. They're beautiful property. I'm going to show you in a minute. Stainless steel appliance, granite countertop. If you don't know what shiplap, it's like these really nice trim on the walls of the rooms. Restrooms are beautiful. All the nice fixtures. It looks like a beautiful house we would go by. Yeah, polished concrete floors. They look like marble pretty much. Electric fireplace. You got these doggy doors, which I just love. Anyways, billions of dollars of institutional money has been pouring into this stuff. Derek was onto this years ago. He kind of knew what he knew and didn't know it was called a thing, and it's called a thing. It's called build to rent. So that's essentially what we're doing. So here's the site. You can actually see it. Google Maps, 12-acre new development, 98 units, like we said. Here's the risky part about development. The risky part about development is, man, the land getting the ability to break ground. This property has already broken ground. We've already developed 6 completed units that essentially prove our pro forma was way conservative. And then there's another 2 that are ready to go. So a total of 8 should be coming online. The last 2, 6 completed and fully rented. The last 2 are coming on in just a few weeks. And it essentially proves what we believed in our pro forma, in our underwriting. This is, this artist rendering, artist depiction, right? This is what we're building. We're building a subdivision, a nice community, nice areas, green space, a lot of great landscaping in and out of the community. People want to live in these units. A lot of people can't afford a new house. They've got family, I need to find a place to rent. This is it. So you can see that this is all stuff that I would imagine. I'm looking at the attendee list. I know most of y'all here. I think you would feel comfortable living here. Your family, your kids, your little ones. This is the community that we're building. So it's definitely not a B or C class. It's a nice, beautiful type of home and living situation. So anyways, here's the floor plan. Here's the beautiful part about scale, efficiency. I talk a lot about this in multifamily. We're getting the same efficiency here, except it's on the front end. 1,200 square foot houses, 3-bedroom, 2-bath. From the outside, the community looks different. It looks unique. Every property, different color, a little different elevation, etc. But the floor plan, man, Derek is, I say Derek, Hammerhead, Capital, and Legacy, and 5 Talents, all of us, man, they were putting a lot of time, effort, and energy into making sure the product comes out consistent, the same thing every single time, same materials, 98 times, boom, 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 boom. Derek's been doing this stuff. He's been involved in about 50 projects like this, not builds, but 50 projects like this. And this is the same in and out, rinse and repeat, and away we go. So the flooring, the floor plan is the same that you're stamping out. Low maintenance design, stained concrete floors, good for turnover. Granite, you can beat that stuff up. Kids are on it. It's still going to look great as soon as we turn the units. And if you know those vaulted ceilings, shiplap, the accent walls is the right word. There you go. The accent walls, custom barn doors. This stuff looks freaking nice. So, anyways, construction timeline. Let's keep moving. Man, this is one of the best. I don't know parts about it. I'm in another development deal, and that thing is much longer than expected. We haven't broke ground on it. We're trying to really get everything to go. This one is the reason I said yes immediately as soon as I was given an opportunity to partner. Not only do they're great people with great values, great mission, which I'll let them introduce themselves, but the project itself for investors, we want to make sure that it's something we're in, or it's off to the races. The entitlements were completed in June of this year. Construction started in July. The first 6 units were completed in October. So 3 months later, you build 6. We've got some really conservative timelines. We're saying the rest of the land groundwork will be completed in May of 2022, which is a good long ways of all kinds of fun stuff, right? Take the core samples and do all the fun stuff with electrical engineering and plumbing, all the masterful stuff that the team does. The construction will end in 2023 is our timeline, and stabilization, get this thing running because they're ready. We've already proven that. Stabilization for the asset in August of 2023. This is nearly a 2-year time frame for something that we can do. Here's the upside secret. Because you're on the webinar, which so we're not going to tell everyone except for us on the webinar and anybody watching the video recording, we're actually about 10 months ahead of schedule as of right now. So look at this schedule for our pro forma. So the construction timeline, I'm not going to put Derek in a corner. Construction timeline is the same. But when you look at the financial aspect of this and how it correlates to our return, our capital in versus capital out, the pro forma is about 10 months ahead of schedule. So this is, 5-year hold, plan for 6. You may want to expect us to get capital out sooner than that, but it's a conservative deal, and this is one of the ways that we've been able to stay conservative. So what the heck are we building? Here are some of the development comparables. So I'm going to let you look at that for a second while I drink some coffee. All right. So these are 3-bedroom, 2-bathroom houses, anywhere from 12 to 1,500, 1,600 square foot. You can see on this map where essentially our development is, the Crest BTR in green. These are properties in Avery Meadows, Acadian Meadows, Cohen States, Briars Cover. They're all really very close in vicinity to the airport, to Lafayette, hop, skip, and a jump away. And we're building properties in this similar class, which I love. And if you want to see what they're selling for, so there are comparables for apartment units. That's not really a comparable. This is the fun part of BTR, build to rent. This is why billions of dollars is coming in. And then I think some people are a little slow to accept it. The faster you can jump aboard, I think it's going to better be for us, our capital, our deals, ongoing. I hope to do many more of these with this team, but you can't buy these deals, you can't buy these single family homes for less than right now in the market, 199 grand all the way up to 245. We saw some of the comps on the previous page. These are even higher. Some of them 250, 267. So when you look at that barrier of entry is what keeps a family from actually being able to rent stuff like this. So you're like, well, I'm starting to buy stuff like this, and why it's very limited ability to actually go and rent it. So at an affordable cost, we're building these things and we're saying, you know what, let's be conservative. We built them. They've got a comp value of 176 grand as the way they are, 3-bedroom, 2-bath. Build to rent stuff is the true BTR comp, which is the cottages at East Broussard, which is a build to rent community that was recently sold right down the street, was sold at $204,000 a unit. They were getting $1,825 a month at 1272 square foot, 3-bedroom, 2-bathroom house, not similar amenities to have like let's just say pretty close. Let's say comparable, right? So they're getting $1,825 a month. Well, that valuation at their project, that's sold and traded for $20 million. At our valuation, if it was 98 units, the same thing that they're selling for, we would have gotten $20 million. We're factoring 16.9. So that's another point of conservatism for this deal. Where the heck is Lafayette, Louisiana? Let's talk about this. Shoot. Derek, you're from Lafayette, you're from Louisiana. You're from the area. Man, can you tell us in your own words, I want to give you the full introduction, but I got a team slide for that. Let's just drill in Louisiana. Tell us about Lafayette, man. Why is it the #2 rated, best small places for business and careers, the happiest place in America? What the heck is going on over there, bro?
I'm not exactly sure. I mean, I've been born here, so I'm used to it. I think a lot of it has to do with the weather, and then obviously the food, and then everyone in this area probably likes their alcohol a little more than they should. So all those things combined, but obviously we have some good economic things. We're in a nice location, convenient to Houston and New Orleans. We're like right in between those. We're close to the Gulf, so we have a lot of oil field sector work. They fly out the helicopters, from our airport. So when the oil field's doing well, it just adds another component that we have here. But we have a lot of hospitals and medical, in addition to the university that has good technology and nursing departments and stuff. So just a lot of factors go into that.
Yeah, so Derek he's like smile ear to ear. I don't know why we're so happy. Y'all stay out of here, but. Essentially, I mean, good food, hanging out, good weather, all that good stuff. Let's look at the data points. And you have a very well-educated, very high-paid median household income. If 46% of the general population is like, hey, bachelor's degree or higher, and the median household income is 72 grand, that's pretty well-educated, well-paid. Lot of good. I guess living, affordable cost of living compared to some of the other areas. You have a great lifestyle in the party atmosphere. And then something I always get from Corpus Christi. I'm from Corpus. That's where I grew up, and I live in San Antonio. I've been looking for some Corpus assets too. Haven't found them, but I'm looking. Everyone always asks me about the hurricanes. Like, well, what about the hurricanes in Corpus and flood? And I'm like, well, yeah, it's the same in Houston, and there's floods over there too. And that's when I hear Louisiana, that's what I think. In terms of geography, give us an idea of where Louisiana is compared to some of the flooded areas, et cetera, et cetera.
Sure. Yeah. I mean, we're probably about 30 miles, 40 miles from the coast, so there's a lot of, buffer there. So we don't get battered too hard. I've lived here all my life, and I've never had to file an insurance claim because of a hurricane. So they do have flood zones. If you live in a flood zone, you're required to carry flood insurance. It's not cheap if you're in a flood zone. Our property isn't in a flood zone, so it's optional for us, and it's just a fractional cost. But yeah, definitely it's something you look at before you ever decide to build. Is it in a flood zone or not? Because it's a huge, if you're trying to sell a home and you're in a flood zone, it could definitely impact that sales price and the number of buyers that would be interested in that. So yeah, those are some big things to look at.
If I could add too, Abel, the way that Derek's been building these, they're like mini tanks, right? You've got this kind of support beam that goes right up that high wall. You've got really condensed walls. Everything's really compact. You've got it's not like vinyl siding. It's that OSB. So maybe he gets into that a little bit later, but we're putting on 131 mile per hour, roofs on this thing. It's not
130 miles per hour.
He's not about to be going to be picking up shingles, Yeah. So I think we're in good shape.
I love it. Well, so let's dig into the projections on the pro forma. I think if anybody has more questions on the market, the deal, the asset, we'll stay here for time, but want to respect everyone's time here. The BTR projections. Okay, so follow with me on this. It's kind of an eye chart. If some of you are not, regularly reading these, but you have your income at the top, all of your expenses, and then your NOI on the very bottom. And essentially, year 0, year 1, build. The beginning of year 2 to mid, we've got this thing fully baked out, all of them built. Year 3, you can essentially see where the total potential income rises and kind of flat lines. Year 3, 4, and 5, that's because the project is fully built and we're humming along. And that's essentially why we're saying a 2 to 5 year period. If you hold this thing for another 2 or 3 years, The NOI does not increase drastically. We're forcing the appreciation. If anybody's a multifamily commercial apartment investor, you know this, or real estate, you're forcing appreciation. We have the ultimate value add on this deal. We started with ground and we're building and forcing it up. And that's what happens. It goes from 0 income to 53 first year, 1.1 year 2, 1.9 year 3. Valuation is very high. Somewhere around here, we're looking to sell. And that's how this deal works. The rental income increases from left to right, year 1 to year 5. If you look at the gross revenue, same thing, left to right. The operating expenses, repairs, payroll, general G&A, marketing, utility, contract services, everything you'll see when you look at it, it's a rise from left to right. It grows over the years. We want to see that as underwriters. I want my assumptions to say it's going to cost more to do this. It's going to cost more every year, and we put these expenses as a growing percentage rate. We do the same with rent growth, which is 3%, is what we're calling organic rent growth. Right now, all across the country, you have people like us that are putting 3%, and what's really happening is they're spitting out 5, 6, 7, 16s in some markets. It's crazy. So we're being conservative and saying it's a 3% rent growth. Expenses grow at 3% also. When you map this out, this is what provides the 62% break-even occupancy by the beginning or middle of second year into the project, because enough projects are built, enough renters are in them. That's where 62% comes in. And when I was talking earlier, our construction timeline that's hard. It's rigid. It's there. But in terms of our dollars, the way we've projected this, we're essentially 10 months ahead of our underwriting as of today. So let me move my little picture. I don't know if that's covering this. On the right-hand side, an expected 700,000 single-family units are designed for the rental market. They're going to be expected to build nationwide in the next 10 years. And the RCLCO, Real Estate Advisors, you can look this up at the Phoenix Business Journal. This was the article they have there, the links there. I don't think you can click them, but just go Google this and you can check it out. Basically, it says they don't even think that's going to keep up with the demand for this. So I feel this is a pretty good spot. We're early on into the BTR and we're getting after it. So that's basically how this works. NOI on the bottom. We're putting all of our money out. Year 1, it's not built. Year 2, operating income to 1.1 to 1.1 and 1.2. Again, that's why I kind of projecting 2 to 5 year hold. What does this mean for me? Right? I put in some money. What the heck does that mean? So what happens is, see if I can squeeze my face down here. You have option 1 and option 2, class A and class B. The returns are the same. The equity multiple is 2.15. To sum all this stuff up, if I put in $100,000 investment, I'm expecting $215K total back. My investment seed was 100. That was your seed. It's always yours. It comes back to you plus an additional 115K if we were to stay in this thing a full 5 years. And that's basically what we're doing. So you see the top, I'm going to go over this investor seed capital balance. You put in 100, it's 100. Cash flow, how does this work? Well, year 0 is today. Year 1 is we're building. Year 2, we're just going to be starting to get to that break-even occupancy that we're talking about. Year 3, the thing stabilizes, kicking off returns. That's why it's 16, 17, 17K year 5. What does that mean for your cash flow? Cash flow year 0 or year 1 is 0. That's part of the development game, right? That's why we're doing this. Is we're willing to take that front end delayed gratification for a back end to 18% IRR. So as we projected, this is fun. This is cool. Part 2. So the absolute total cash flows, this blue and black chart is saying if I put 100K in, I'm expected to get 2,300, the absolute total cash flow, 2,300, then 16 year 3, then 17 year 4, then in year 5, it's the return of capital, it's the equity gain, it's everything. So when I add all that up, that's 215 grand, right? So your total return on equity is really the 2.15 1.5 equity multiple. However, this is the upside potential. The upside potential is we underwrote the 1.2 million in contingency. We're 10 months ahead of schedule, and essentially we underwrote at rents. If you can see this to the left, original underwriting had rents at $15.15 a month for all the units. Well, today those units, the same units, are getting $16.50 today on the 6th. And we're getting $50 a month pet rent because we put in those nice doggy doors with a nice backyard that everybody has. So there's effectively $1,700 per rent. We underwrote at $15.15. We're already proving we're $185 per unit above. Because he was like, I want to make sure we're conservative. And I was like, I get it. It was a conservative.
Hey, well, if I could step in, because I know like this is kind of where people start to be like, oh, hold on a second.
Yeah. Go for it.
We did have a very unfair advantage, right? We came in with the land, we had the bank, we had loan, we had the track record, we had the previous projects, we had a lot of the subs that had worked on projects for years. So, and also if you remember at that time, we were underwriting, the cost per 1,000 foot board was really high, right? So we wanted to make sure we had a lot of conservative, risk mitigants in place. But if there's somebody kind of, I like to say, like washing their dishes right now, like this is the part to tune into, right? The part to tune into is that you're able to get into an investment now where the actual rent is $130 more than what we originally underwrote it for. And as you know, with inflation, typically when rents go up, and inflation goes up, rents go up. However, even when inflation kind of regulates down, rents usually do not regulate down that far, right? Even in 2008, we saw rents came down that one part of the year, and then they were just consistently back up. So that's the juice in this deal, is that all of the other risk mitigants are still there, but our rents are $130 more today than they were when we started.
You've got hedge protection and downside risk aversion on one hand, and then you have this huge upside potential on the other. You don't find deals that the partner's already like, oh, I got $1 million in this deal, and I've had it in here for a number of months and a year. Well, we got lucky because if I can, Derek, we got to know Derek on a personal basis. We've been in a mastermind, Christian Kingdom REI mastermind for almost 2 years now, and just kind of get to know each other. Well, he already owned the land. He already's been doing it. He already has the expertise. Their crew has been doing this rinse and repeat over and over again. And I was like, well, what about doing build to rent? And then he's off to the races. This guy's, we're catching him at a great spot in his career. He's done enough of these to know how to do it, but starting off this new $100 million fund in the future. So this is the deal, and I'm super excited to join. So thanks, gentlemen, for having me on. So that's how your money behaves, right? It's like, okay, conservatively, I put in 100K in, I want 215 back, but that's an 18% IRR. With the upside that we're just talking about, it's really a 24% IRR, still having the exit cap of 100 basis points above market cap, and still the extra reserve or contingency of $1.2 million. So I'll keep moving. Okay. Yeah, baby. You guys know me a little bit. Abel Pacheco, nice to meet you. Hang out with you guys, talk with you. Thanks for supporting and joining. And whether or not you're investing in this deal, thank you for liking, sharing, commenting. I'll put this video out there, and I appreciate. Thank you very much. I look forward to bringing more assets to invest in. Derek, man, the man of the hour, and Andy, the team, the crew. Let's start with you all. Introductions. Whoever wants to go first. I'd love for you to talk about your experience, what you've done, why you're here, etc.
Yeah. So I'll start. I've been in this game about 20 years, Abel. I started off on the brokerage side, and then kind of quickly figured out I wanted to be in the development and acquisition side. So we've done a lot of multifamily. We've done a lot of development projects. We have a number of units as passive and active lead sponsors. But really, what kind of led me down this path is this guy. I mean, he's already done it. he has big plans about building out the fund. And that's part of the reason that you all here today have kind of a unique opportunity, because we're coming in on this project that's already started. We've got an opportunity to kind of come in the middle part of the process and collect on all of the fruit of his labor. So go ahead, Derek. Why don't you talk a little bit about yourself? I know you love doing that.
Yeah. I live in Louisiana. I was born and raised here. I've been doing real estate since 2002. Started like most folks, just buying and remodeling and renting them out. I've done it, year after year. Probably about 10 years ago, started to realize it might be a little easier to add. I think I did a duplex. I added a unit onto the side of another unit, and I was like, that was a lot easier than doing a remodel. You never know what you're going to get. So I decided to get licensed and become a general contractor. And since then, I've just been building them mainly for myself, just building and adding more units every year. And I just enjoy the benefits of it. And through that, I've gotten to experience the tenants as they walk the units, what they really like the most, because I also handled the leasing on these over the years. And that kind of led me to different floor plans and designs to kind of just key in on what gets the best results from those folks. So I enjoy it.
Yeah. And both of these individuals are like super humble individuals. Andy, has done $750 million in commercial real estate transactions for 20 years. It's pretty mind, blowing to say, oh man, I'm blessed and privileged to be, partnered with him. And then, Derek is starting off as sometimes you hear, oh, general contractor and a builder, leave you with the work. This guy has owned, if I can talk about your portfolio, he's got a huge portfolio in terms of number of units, and just did it over and over again as an investor. So construction, general contractor, builder, developer, but then as the owner of what you develop, you've got a different hat on. You don't have, the costs are the costs. It's like, I got to make sure that this is right, because this is an investment. And a lot of time and years have been spent to like the culmination of like right here. And just happy to be a part of the team. If some of you don't know me, if you see the video recording, I had a lot of years, 20 years in professional side. I had a tech exit in 2016. I was in IT at Rackspace, literal unicorn, tech unicorn. Went from $100 million in business when I started in 2006 to $2 billion in 2016. My team went from $5 million a year, my little org, to $57 million a year before we were done. So I had, started as an individual solo, commission only sales guy, to leading a team of about 60 sellers as a director, 6 or 7 managers. And that 10X run, really doing, millions and millions and millions of dollars. The reason I was able to have success in that area was because I hired people that I thought would be better than me over the years, developed them, led them, and they had tons of success. I literally try to put people better than me around me. I'm having success in commercial real estate because I'm basically practicing some of the same. I'm being led and mentored and coached along the way, which is good, but I'm still partnering with people that I think are better than me. And these are the best possible people in my network to do this deal. That's why I'm partnering with them. So excited to have part of the team. So anyways, this is 8:12, baby. 40. So we are almost at the 45-minute time. I said 30 to 45. So I told you I wouldn't get over. Here's the investment timeline. You can read the bullets. You basically have to, I apologize for these deals sometimes because they are first come, first serve. We unfortunately can't reserve a spot. As soon as the bank account's full and we're ready to go, we're ready to close. The deal has essentially been committed. 65% of the $2.5 million is already committed for today. We still need the actual dollars in the bank account. So it's not like, you still have time to say, yeah, I'm in, signed docs should be available for us tomorrow on our portal and then sign. But out of the $2.5 million, if you look at 35%, there's about $875K worth of space committing, something happens last minute, end of the year deals, et cetera, et cetera. But the offering memorandum is basically, this isn't, as a disclaimer, I have one more slide. This wasn't the official OM. It's just the, walkthrough. But the official offering memorandum will be in a portal. I'll send everybody a link here. You can, copy and paste that as well. But anyways, the offering memorandum is available now. First come, first serve, run commit. You're signing, you're executing. You can sign and not wire, and someone could beat you to the punch. So until you sign and wire funds, until we have it and say, hey, you're in, you've made it as part of the 2.5 million. That's the only time you actually reserved a spot in the deal. But after that, once we're full, we're going to stop. Let's just say December the 15th is our hard cutoff. And then we're starting quarterly performance reports. So every 3 months, send you some reports. Infrastructure is completed, construction continues, and construction is complete 3/23. And that's basically our investment timeline. And in the chat, since you are here first on our portal on our recorded webinar. So I'm going to send the link here. Everyone will get it. Let's see, everyone. This bad boy. Everyone else that wasn't here, that's just looking for the recording, they can wait on their link. They'll get it 2 days from now or tomorrow or something. But everybody has it now. So you could commit. That's why you were on time and here with us. And I say thank you. So next steps, here's that, here's the website, what I just put in the chat for everybody that's here. You can review and submit a soft commit. Here's the fun part about these deals too. I am partnered in a number of teams, there's amazing people, but we all have these portals running around. And I'm sorry, I've got one in Agora, one in Juniper Square, one in Syndication Pro. I'm trying Invest Next because I think it's really, God willing, the one that we're going to move to. They have, you don't have to wire. They've got a wire transfer within the portal, and I really like. So anyways, this is the next portal we're trying. Apologies. I'm taking you to another portal if you're an investor with me. But what you do is you submit, sign, whatever, move forward. If anybody's investing more than 500K, let me know directly, and then we can talk. But after that, that's it. So 8:15, 45 minutes on the money. Disclaimer, go ahead and read this. It'll be in the OM, it'll be in the PPM. So I'm bowing out for a second and stopping talking. We'll go to questions. Let's see. Well, 4 questions. Here I am going over. Andy, Derek, did I miss anything that I think we should have covered, or anything that we didn't hit hard enough here?
I can't think of anything, Abel. I mean, I'm sure that there's some questions just in general about what we're doing. But I think you covered the BTR trend. I think I would really encourage, now that they've seen this, I have a feeling they're going to be hearing more and more about it. It's kind of like that car you're looking to buy, right? It's everywhere now. So
okay.
I think you got into it. Derek, was there anything you were hoping that you covered?
No, I think that's pretty good.
Yeah. Well done,
okay. I see 2 questions so far. One's on the risk in Lafayette area with respect to hurricanes. So I think we actually covered that one earlier. Inland, insurance, not in the flood zone today. If there was, we'd have pretty hefty insurance. We're not, but it's good. It's good to have it, right? So that's the part. And then the way they're built, actually, the actual units. So all of that is good. The other one is, could you touch on the tax benefits?
Sure.
What write-offs do you look like in the early years?
Yeah. So it looks like we're going to have a pretty healthy cost segregation study. So that would be, the majority of the units would be next year, right? So that's a 2022. So sorry, we don't have any Christmas presents for you guys this year, but next year we will. And so far, we're talking in the 65 to 70%. So if you put in 100 grand, you would have a negative K1 in that 65 to 70 grand. We're also looking at a couple of other incentives, basically just building incentives. So, but at least a very healthy cost seg.
All right. Let's see. Typical questions: minimum investment, 50K. The difference between Class A and Class B share. Class B is really just 9% preferred return. Can you use retirement funds? Yes. Any qualified retirement funds, self-directed IRAs, 401ks, solo 401ks, anything that you can basically direct into the investment, you can get in there. And that's it. So, all right. Well, unless anyone has any other questions, call it a wrap.
Let's do it. Thanks so much for making it happen, Abel, Derek. Appreciate you guys.
We appreciate it. Thanks for your time. Thank you. I'll send everybody out. Everyone that was registered, get you an email, and then everybody else that's not, let me know. I'm happy to help you when you see this recording. Talk to you soon. See ya.